try and also for us to invest in this frontier markets, so to speak. Partnerships is key, and leveraging each other's strong points, I think, is necessary.
Thank you. That makes a lot of sense. And I'll get back to your example with Helena Sahlin from SIDA. But just before, because of our delay, unfortunately, Amena Arif from IFC needs to leave us. So I'm going to give her the mic just to say a few words before she leaves. Can you go with that? Thank you.
And apologies again. If there was a meeting I could avoid, but unfortunately I can't. I just wanted to come in on a couple of things before I leave. So one is on the competition that we're talking about. And I think that competition absolutely completely exists. And sometimes it's a race to the bottom in terms of pricing, to get it, and how can we get this deal, and how could you get this deal, and so on and so forth. And yes, that's a problem, but I don't think that's the problem that I would focus on. I would focus on the fact that it's actually that there are not that many bankable projects. So the pipeline of projects is very limited. The need is much, much larger. If you look at the numbers, there's absolutely no reason why any of us should be competing for projects. I mean, look at the tremendous amount of capital that is needed. But that need is not translating into bankable financing, finance-worthy projects. That's I think, a big issue. So from an IFC perspective, it's certainly something we've kind of identified as an area where we need to work in, which is why a few years ago, we formed an entire new department, if I can call it, within IFC, or an entire new approach, I have to say, and we're calling it upstream. And basically the purpose of their lives is to help develop a bigger pipeline of bankable projects, not just for us, but also for all the development partners. So take ideas, identify a need, and if there isn't a private sector partner willing to put up a project to address that development gap, let's try and bring that into being, okay, literally create it. So if I can give you an example of Malawi, where we are working with a number of different development partners, and we're working on a hydroelectric project. It's been underway for a few years, but that project didn't exist. IFC came in as a co-developer, so we actually germinated the idea through an upstream approach. And now it's $1 billion project that is going to double the country's, generation capacity, and all with renewables. So, it's that creation of that larger pipeline that I think is also critical beyond the coordination, which absolutely must be done. But, you can only coordinate on 3 projects. It's not, we need 300 projects. The second thing which I want to come in is something that, you've mentioned, and frontier markets. Doesn't matter whether we call it frontier markets or not, right? What matters is the private sector sees them that way. And I think over there, again, I want to point out the risk appetite is different. So when you talk about the different roles, I cannot stress that enough. Our role, IFC in particular, is focused on the private sector. The private sector within its own spectrum has very different levels of risk appetite for countries, for projects, for industries, for technology, for anything. And you can see how that plays out in something as simple as solar energy. There was a time where DFIs had to step in to finance solar projects. You needed grants, you needed funds, you needed guarantees, etc., because people were not willing to take the risk on that, either the technology or the approach or the idea that solar could, feed into a grid, all kinds of different obstacles to introducing a new technology. But over time, we've done what we were supposed to. We worked ourselves out of a job there, right? The commercial banks are absolutely, totally willing to finance it in most countries. It's only a place like, I don't know, Burundi or DRC or somewhere where we still need support, where even IFC to help mobilize that private sector investment needs the support of FCDO or SIDA or someone to come in with different risk layers. So think of it as a layered cake, right? You need those different layers. Unless that base of risk capital and risk appetite is available, you can't build on top of it. So I'll stop there. Thank you. And again, my apologies for having to leave.
Thank you so much, Amena, from being here with us and sticking with the session. And I think there were very important points. I'm going to probably get back to the panel after you leave with some of the reflections. But you mentioned something that is not all countries are the same, not all private sector sees them as the same. And we also heard before how important is the catalytic aspect of transformation, how some actors in this ecosystem need to step in and to create the ecosystem for a great idea to become bankable, to get the interest of DFI to work on, as well as the private sector then to invest on. So again, there are different actors with different roles looking for different types of returns. And when we talk about impact returns, they are so hard to measure. I mean, there is no yet accounting for it. I mean, everybody understands accounting when money gets in, money gets out, there is a profit, but impact, we cannot measure impact only on the speed of our programs or spending the money, but also on the changes of lives and the planet that we are working on. But again, thank you very much, Amena, from being with us. I'm going to ask now Julius and Hayat to talk to us a little bit about how the changes in backcountry when there is a mandate transformation, when you have initially programs that you are working on, and then there is a massive reorganization in places we were working before, the agencies, and how that can be of impact, if positive or negative, and how this is worked internally, because we all live through transformation in our organizations, but how can this affect the programs and the lives that we are talking about here?
Thanks, Celine. I think from my experience, the recent change with the reorganization with FCDO and BI, I don't think it has any impact in terms of our overall broad strategy, in terms of focus, prioritization, in terms of what we do. Actually, there are a number of good benefits in terms of us working closer. Now we are part of a board where we discuss in terms of how we complement the different organization in UK. We work closely with FCDO in terms of some of the how they can help us in terms of the government programs in many countries. So one of the good example which recently been very successful is in DRC. The UK aid supported the DRC, the government, in terms of identifying bankable project in supporting renewable energy in a very far remote area through mini hydro grid and then also distributed renewable energy. I think from the upstream aspect, I think the UK government help, and then from BII, one of our platform is called GridWorks, where it's established to develop the transmission and distribution network in Africa, which is the main bottleneck in terms of energy access. Now we are actually working to approve the first investment of mini grids in DRC, Virunga Power. I think it's quite developmental. We did a very broad impact assessment to see it's very remote in the northeast of DRC, which is high conflict. So I think in terms of work, I don't think the change brings anything. Actually, with the new rebranding and then in terms of getting more funding, we're becoming bigger. We have now a big strategy in terms of investing in Africa. Thanks. I'll give it to you also. Yeah.
Yeah, thanks. I mean, Hayat's covered the ground. I would probably add two related points. I think one is around cohesiveness. So what the reorganization has helped with is that project development that Amena also talked about, making sure it's aligned with, for example, UK export finance. So you come with a more kind of cohesive package, and I'll talk about why that matters in a second. The second point is that sometimes in life it's not just quite a technical issue. Sometimes sort of politics comes into it, and partner governments will want to know, is this a kind of credible project? Is it a credible proposition? What's this organization? And I think having that political support for the DFI can help. And also where they face a problem on the ground. I mean, we'll often get a call saying, can you help us unblock something, which feels like a more political blockage, and that's again something we can help with. If you stand back and think about impact for a second, and forgive me, this is a Kenya-focused example, but then CDC, now BII, has been heavily investing in renewables. One of the first investors in geothermal here in Kenya, not BII, but other investors into Africa's biggest wind farm, Lake Turkana wind farm. Now more recently, BII heavily involved in Malindi Solar, East Africa's biggest solar farm. Kenya's now hit 93% renewables. I think few of our countries are up there, and yet they've done that very much with DFI finance. So the point being is when this happens well, it's a beautiful thing to see, and it makes a real difference in terms of electricity to the grid and green electricity at that. If I can reflect for 1 minute on the barriers that I think, not barriers, I think the sort of trade-offs that we're thinking about. So one, Adolfo and others have talked about is risk. And the sort of story goes something like this: there's this wall of finance, particularly green finance out there, and it can't find the projects. And then you have a whole set of other people who are going, there's all these projects, but there's no finance. So those both can't be quite right. So I think the challenge that we're facing is sort of how do you bridge that gap? That feels to us like the ultimate goal on a lot of this. And it does come down to risk. I think it comes down to ticket size and how we, it takes a lot of work for the bigger deals, but it takes about the same kind of work for smaller deals. Those kinds of things, risking finance, risking ticket size. But for us, it's just, it's somehow finding ways to bridge that gap, I think is going to be the key thing over coming years.
Thank you, Julius. Funso, you seem provoked. I think you want to intervene and talk a little bit about your role at AfDB. In the afternoon, we're going to be talking with the private sector just after lunch. And the topic that we suggested the banks to come and talk to us is not only the interest or the trend of working in what they call, or the world called ESG, the environmental, social, and governance, but how they look back to us, program managers, the UN system, the DFIs. So if you can elaborate a little bit on how AfDB is working locally and in the other countries that you work in the region would be great.
Good, thank you. The advantage of being the last to speak is you can easily say, I agree. And I think I really do agree with all the points that have been raised. Now, I was boiling. I wanted to just put a context to what Anima said before she left. And colleagues, let's put some numbers out there. First and foremost, we're talking of a continent today that needs anything between $150 to $200 billion every year for the next 10 years to reach a level of growth that is a little bit commensurate to the other regions of the world. And if you ask how much have we done, we're doing not up to 50% of that. So basically, if you combine the resources for all of these partners here, it's not anything near where we need to be. And that's very important because then it tells you that there is really no need to see competition. And I don't think competition is an issue. What we should try to avoid by all means is duplication of efforts. And I think it's very important because the space is so huge, the needs are big, And there's a space for every one of us to be able to bring our resources, bring our comparative advantage as well, to bear in order to be able to do it. And there are a number of examples. Julius, you talked about the wind power, Lake Turkana wind power project, 310 megawatts. And I think about 11 DFIs are probably involved when DFIs are private sector. And that tells you that it can happen, and it's already happening. What I think is very important is for us to begin to have this deeper level of conversation amongst ourselves, where we don't come to the same client, say in this case, the government of Kenya, we're trying to price ourselves out. I don't think that's what the approach. Rather, we want to look at who is best placed in doing what. Who has demonstrated the capability and the experience and the competence over years to provide the best of service to the interests of the African country. And I think that is very important. And what AfDB does is very much at the forefront of that. There are sectors that you would not see us playing a major role in because it may not be within our comparative advantage. One of the sectors that is definitely, obviously within our comparative advantage is areas of using infrastructure to create regional integration. And one of the areas, and what we do, and I like the point that she raised, and I think it's very important, you see, before you get to the point where you hear that $200 million has been committed for this road project, understand that there's a whole layer of work that has been done for years before getting to that point. Some of them could involve helping the government to develop that, policy framework that provides the policy incentives and the enabling environment for us to be able to come in. Another layer could be that developing the idea. So it's one from idea, taking it from ideation to a little bit of feasibility study. So we have different types of technical assistance and grants that before we do the conventional financing, it may have gone through 2-3 grant system of, layering and ultimately scaling it up. Because sometimes big is better in the context of Africa. Now, coming to the question of ESG, I think, and I can definitely say, I've had a chance of interacting with everybody here. ESG is not something you should be doing. ESG is something we're already doing. It's very much embedded within our operations. It's very much embedded within the way we give value to what should be financed or what should not be given money to. What I think it's important is what the private sector, particularly those, to understand that the impact we're trying to create through our investment, the impact that there's a demand for them. Whether it's economically viable, whether it's socially viable or environmentally friendly, there is a demand for that. So we're not forcing it on people to take that. The local beneficiaries really want that. They don't want an infrastructure that will deplete their natural endowment or their natural habitat. What I also think it's also important is to also see how we can use ESG as an incentive for pricing of cost of capital. So we started something at the AfDB called gender lens financing. So if you're able to come up with a very solid gender framework in your project as a private sector, it could actually influence the way we price the capital. It's the same with green investment. If we're able to account what is the GHG emissions reductions that you're going to achieve, what is the impact of your project in climate resilience, we're able to blend, climate finance that we have got access to, together with our concessional capital, in order to price the, to make the cost of capital lower. So I see more as an incentive approach, based and rooted within the principles of how we work, and that becomes a lot easier to sell itself. So I'll keep it here, but I'm really enjoying this.
Thank you, very inspiring, Alfonso. Maybe I ask Adolfo to talk about a fund that the European Commission is creating and in what it's trying to address.
Yeah, thank you so much. I didn't come here to sell my book, but since we are talking about this topic, let me share with you the latest of what the Commission is doing. I shared with you before that 2017 was a special year for us because we launched the external investment plan with more capital for investments through blending, eventually guarantees. So actually, 2018 is when we launched a kind of call for applications. It's called the European Fund for Sustainable Development, that basically is guarantees. It's guarantees for DFIs. And guarantees for DFIs that range from European Union DFIs, but also is open to other ones. And eventually that led to the signing of different guarantees contracts in 2019, 2020, some of them with our friends of African Development Bank, even with the IFC as well, and some other DFIs. That was a 1.5 billion size of guarantees for investments in different sectors, and that was a kind of a pilot program, a kind of a pilot to see how we are doing, how we are signing the contracts, how it's going to be deployed. But now we are in a different programming period of time, or a different kind of budgetary period for us, 2021, 2027. For this one, for this period of 2021, 2027, we are multiplied by 10 the amount of guarantees. So it's going to be approximately 13 billion that is going to be allocated in two different kind of calls, applications from DFIs to get the guarantees. The first one is open now. It's open now. It was open middle of April. The application period will finish middle of July, and that will be an allocation of approximately 6 billion, leaving the extra money for 2024. So we are in the process now of allocation of these guarantees. We are seeing guarantees that have been requested for many different operations. Sometimes some of these operations are for investments of DFIs in companies, direct companies, what we call corporate investments, big size. I mean, those are normally above 10 million. But also for investments of DFIs in private equity funds, venture capital funds that they invest in a smaller ticket size in the region, not only in East Africa, but in the whole continent, also neighborhood of the European Union. So that is actually ongoing now. Different sectors also, we are seeing requests for guarantees on new topics like forestry, for example, moving away from traditional sectors as energy of transport, where we have a lot of blending operations, a lot of different kind of guarantees, but we're moving away from that. We're going into something that is longer term periods, more risky actually. That is the purpose of the European Fund for Sustainable Development. Moving also into other kind of operations like sustainable cities. I mean, investment in what we have seen here in Kenya, bus rapid transport system, electric vehicles, all kind of things. So we are quite positive about what we are seeing already, what is being applied. We'll see how we'll end up in different kind of contracts. And maybe let me add something now. I mean, we just saw the East African Venture Capital Association report that came out actually last week, where you can see the number of private equity investments in the region. I mean, in the region means Kenya, Uganda, Rwanda, Tanzania, include also Ethiopia. And there has been a bit of a stagnant amount in investments in the last year. I think it's related to COVID somehow. But you can see that the investments on private equity and venture capital, about 40% come from DFIs. I mean, that is the reality. I mean, you also have investments coming from family office, but DFIs are very important for mobilization of this kind of capital. And also, you have local capital being mobilized. And I would say that it's not only about DFIs mobilizing capital. There is a lot of potential to mobilize capital that is already available in the market or in the country. I mean, there is a lot of money in pension funds, especially in the East African region. I used to work before in Uganda. We managed to create a private equity fund with investments from the European Union, but also the pension fund of Uganda invested on the fund. And we also had some other investments from family offices. But the combination of DFIs with private investors, other foundations, and local capital is very important. And that is where I see the DFIs have a very big role to play.
Thank you. Thank you, Adolfo. As I think was Amena saying before that there is no lack of financing and there is no lack of projects. And one thing that is really in the core of what we are trying to do at the Joint SDG Fund and this event specifically is to really create that environment and establish that ecosystem. But we also heard today about how to work together, how not to duplicate efforts. Maybe Elena and Teddy can give us an example of how SIDA and DFC worked together in the past, and then try to explain what was the challenges and what was the benefit of working together. Maybe you give that to Elena, give this to Teddy.
Yeah, I'm not privy to the intimate details, but I'm sure she could. I think with the guarantees that exist, sometimes for us to go through a credit process, especially if it's a new and upcoming sector like the distributed renewable energy or solar, off-grid storage, etc. Sometimes the risk mitigation that exists within that project is a key factor being determined as to whether we can or cannot fund the project. And I think SIDA's support in several of these projects has been helpful. I mentioned the example of a fund called the Solar Energy Transformation Fund, which is being managed by Sunfunder. I think SIDA's guarantee there was instrumental just in terms of enabling DFC to come in with the debt capital for that particular fund, and the fund has been able to operate and demonstrate success in terms of investing on the off-grid space, and now hopefully they'll be able to raise another fund in the near future. So this kind of catalytic financing is important. One thing though I'd highlight is that it's important that when we think about catalyzing different investments, you also think about weaning this, investors off this catalytic capital. So, we cannot have a situation where we provide a guarantee and even with the demonstrated success, there is no further capital or sustainability thereof of that particular investment. I think ideally it would be that we provide a guarantee, an investment is brought in, and the investor recognizes that this is actually a viable investment area, and they will be able to carry on, in the usual sense. And one other thing I would highlight as far as just this, catalyzing investments is how we also catalyzing different pools of capital. I think I would highlight, USAID's, initiative to bring pension fund capital into the continent, because that's a deeply untapped a pool of capital and quite vast, to be honest. So, conducting that effort of bringing these pension funds to the continent, showing them the opportunities, showing them that actually, are you really thinking about Africa as a risky continent because it's perceived, or is it real? And being check.
Yes.
Yeah, I'm saying, and being here, these investors being here and recognizing that opportunities exist and they're not as risky as we perceive them to be, that I think is an initiative that can go a long way into tapping a new pool of capital. So that is not just SIDA, catalyzing DFC capital, and we leave it at that. We also need to expand into other forms of capital. Kenya alone, our biggest foreign exchange earner is diaspora capital. But is it going to productive uses? No. How can we create structures so that this 3 billion coming in a year is going into investments that is going to actually, improve the socioeconomic well-being of the citizens of the country? Thanks.
Thank you. I don't know what to add. Maybe going back to the history, when SIDA was developing the guarantee product, we actually looked a lot at USAID at that time, and now DFC. We also established an agreement because we saw a lot of similarities in terms of strategies, sectors, and goals we're trying to achieve. So many guarantees were issued within this agreement and are still being. But also, besides the de-risking, and I think a lot of good things has been raised since I spoke the last, about the risks, about the projects, bankable projects. I think we also need to again, come back to the capacity building of the businesses, capacity building of the financial sector, and capacity building of the governments on the policy levels, because de-risking in itself will not do the work. Risks is more than just risks within the financial. There are a lot of other risks. That's why the investors are not interested in investing in the markets where we want them to invest. So I think also coordinating on what kind of capacitating we are doing in order for the de-risking instruments being successful at the end. I think this point needs to come back now when we have been speaking about the guarantees and how much we issue, because not all of the guarantees are successful. We also see that a lot of funding is needed in order to see that the projects are additional, that we're bringing something new that wouldn't be happening without the guarantees. We need to see that the risks that we are addressing are being eliminated with time, because we still see that guarantees that were made 5-6 years ago maybe didn't bring what we were expecting. So it's also time to understand where the capacity building is needed, and how do we, with the guarantees and loans, are bringing the value impact to the markets.
Thank you, Helena. We heard a lot of different things here, and apparently, from my point of view, there is no lack of interest and capital on how to structure this. If I were to ask you, what would you expect from us at the UN system? We are based in different countries. We work for different agencies, but there is also the interest of being recognized as a player in blended finance, being recognized as an important stakeholder that create the transformative change that is needed, can be the one organization or different organizations in the same family that can make those great ideas to shine and get attention from you and the private sector. If we know there is this divide between what is possible and what is not possible, but if we were to change, or if we want to add something in our skills as the UN system, what would you like to hear from us? Maybe I can start with Fonso and then come back.
Well, okay, I need to be very polite here. There is a technical answer, there's a political answer. So the political answer is it depends. But technically, I think it's very important to understand that politics drive everything. We can't ignore. We are often financial institutions, but we can't claim to work in an apolitical system. Absolutely not. And unfortunately, we're not political actors. So given your role as the part of the UN that has this political mandate, I think it's very important to be able to understand how do you come in to understand the political landscape and also find a way to make sure that whatever is happening in any country is consistent with investment flows into that country. Because unfortunately, we cannot do that. Secondly, as well, there is a lot of work that needs to be done in helping countries take the ideas, their own idea of development into reality. And there's a lot of roundtable conversations that need to happen among multiple layers of stakeholders in a country to be able to say, is this a project that we want? Is this a pathway that we want to follow to reach development in our country? And I think those level of conversations are very important, and they are very upstream. And I think an organization like yourself can do that. The last point is, given the nature of the fund that you have, I think consider that if you ever have, let's say, $20 million allocated for a country, let's say Kenya, I don't think you should ever do a $20 million project with your $20 million fund. Rather, your $20 million money should be seed money, should catalyze additional financing from all that. So if the project that was initially designed was meant to be 20 million, let's find a way to scale it up, to grow it, to expand it to something bigger. Then we can use that $20 million facility that you have to be able to bring in other sources of capital. And I think that would be the way. We've seen too many small projects all around, and the money that you're using for 100% implementation could have been used to catalyze as a seed capital. I think I'll keep that. You may not agree with me, but I do understand. But I think it's very important to understand the role that you play as a political and financial actor combined. Thank you.
From my side, I really like the idea with this SDG fund. I like the idea of donors coming together to pool their resources into one place and to both capacitate, which was the last point, the markets to be ready for the investments, but also taking the next step of thinking innovatively, launching the bonds as you do, launching the new instruments that we might not have the time or mandate to do. But also when you do, please ask if we would like to join forces. So that would be my expectation. But I'm really happy to see such initiatives where you pool things and use your capacity and your knowledge, because you have a lot of knowledge within the organization, to do innovative, interesting things where we can come in with capital or guarantees or whatever it could be, but you do the main thinking behind and the mapping. So yeah.
So I think there has been a lot of discussion in terms of competition. I think if you look at in terms of the continent, there is huge infrastructure and other investment need, I think mainly driven by growth, the demographics. I think the population in Africa will be 2 billion by 2050, and then 1/4 of world consumers is going to be Africa. So for me, I see a lot of need for investment, and then also this is coupled by the SDG goals most UN and most government commit to. So I think the issue now, I think Amena put it very perfectly, is lack of pipeline bankable product. I think this is where I see government, UN agencies like you, and then also I think World Bank has a big role to play, is in terms of creating a scalable investment ecosystem. I think that's where we are lacking. Then the issue is that, okay, what are the current constraints not to have? I think there is political instability in most African countries. There is macro issues, and then we also have lack of capacity. I think these are the 3 key areas where if we have a fund like UN SDG fund, we can put together in terms of creating a stable macroeconomic environment, which is critical in terms of creating a moderate fiscal deficit, low inflation. I think all these reduce risk perception by international investment. There is also a huge, inadequacy in terms of governance. So there is a lot to be done, capacity building, both at government, NGOs, the civil society, and then even the business. I think one thing we are dealing with a small size investment. I think in BII, recently we're trying to work a lot with local investors. The issue we are facing is capacity in terms of ESG, corporate governance. So there is a lot to be done also at micro. The other concept, I think it was discussed in the previous session, is concessional financing. I think in infra space, even in water sector now, we are really in BII focusing to penetrate the space in Africa. One of the issues in terms of, because of the subsidies and the affordability issue, it's very difficult to create a commercial financing proposal. So we can do through some funds, do some viability gap funding. We can also do some TA in terms of creating bankable. I think those are the few areas where I can see a lot of support for UN and some of other public-related institution where I think we can benefit from. So I think there is a lot of complementarity in terms of in the space. Thanks.
So, so two sets of thoughts. I think that the first one is just an example of what I think success looks like. And, you know, we do a lot of things that don't go so well, but one that we worked on that went really, really well was on affordable housing, in fact, green affordable housing here in Kenya. And we worked with a group called Acorn in basically in three ways. One is to kind of help develop the project. The second was actually to work with government on the regulations for green bonds. And then the third one was actually a partial credit guarantee. And so then Acorn, they launched Kenya's first private sector green bond. They launched it on the stock exchange here, and then they cross-list it in London. And the point about cross-listing is that it signals to the market, so it's helping build your capital market. And it's also and it then gives them the ability to raise more finance. So when I think of that example, and then I think about the question you've just asked, it feels to me like the key point is a comparative advantage point, because I'm not sure that that you'll be able to compete with the City of London in terms of that private sector side or the multilateral development banks in a way. But I do think there's the role, and I think Hayat put it very well about developing the pipeline. That's what helps bridge the gap between the wall of money that people talk about and all these projects that aren't quite bankable. So I think that to me feels like the bit to focus on. But I say that with a lot of humility as a sort of start of a discussion rather than like this is what the answer would be. The principled answer is, you know, absolutely focus on what's the comparative advantage given what others are doing. But I hope that's helpful, and I hope that would continue the discussion.
Yeah, thank you very much. Well, I think that we are sitting in this panel is because we are talking about unlocking capital for sustainable development goals in many different ways. We have been discussing that there are issues both in the supply of capital side that somehow we have tried to address it in the last years. We'll see the success or no. I mean, I think it's too early for us to know if some of the new instruments that we have put in place, they are successful in unlocking that capital. We'll see. Maybe in 10 years' time we come back and then we sit down here and we talk again about that. So there are issues of supply of capital that have been addressed, and somehow I have the feeling that as the UN family, you are already trying to address that side as well. I mean, we are talking about the joint SDG fund where eventually different investors can put place. So supply, you already have a role that somehow you are already playing. And then on the demand side, so I will continue with the mantra of pipeline. I've been talking about pipeline is something that is needed. So pipeline on many different ways, because pipeline is for maybe more government kind of program where you involve the government and then you end up having a PPP where DFIs eventually end up investing. But it's also a pipeline for companies. It's also a pipeline for smaller companies that end up invested by a venture capital fund. So there is a role to play there. You have so many different agencies where you have different level of expertise. You have IFA that is very, they are experts on agriculture. You have UNEP on green programs. You have UNCDF that is already playing a role on supporting private sector. So from the demand, you have a role to play for sure on pipeline building. Yes.
I agree.
You learn fast.
Yeah. But yeah, I agree, you know, from the catalyzing of investments, you know, if you have 20 million, like make sure you catalyze it for more, you know, capacity building, as mentioned as well, pipeline and trying to build bankable projects. I guess the challenge just remains, there's still a clamor that, hey, there's a lot of projects, they're not getting money, and there's still a clamor that, hey, there's not enough bankable projects. So one thing you can do is figure out why we have that divide and bridge the two, right? Because I'm sure both sides need to adjust some things, right? Whether it's risk perception, whether it's the way they present transactions and that kind of thing. One other thing I'll highlight is just education. and just trying to especially show exemplars of transactions that have come out of this coordinated kind of approach, whether where an agency de-risked it, it grew enough, it got now private capital, etc., just to show that this is one way in which this can be done. And whenever now you're making, for example, investments from your SDG fund, targeted de-risking is important, where it's like you're maximizing the chances of this company getting funds from DFC or from BIIs, because you have started with the end goal in mind, which is this is what DFC is looking for. So let us try and find investments that are a little bit behind for their criteria, but then once we support them in a way, they can be able to fall into that pipeline. So being targeted in that approach, so that different agencies are not doing their own thing, and then there's little linkages between each other. Thank you very much.
Thank you, Teddy. I'm responsible for partnerships and engagement for the Joint SDG Fund, so you're going to hear a lot from me. But just to be mindful of time, we are between you, another colleague that will be presenting Timbuktu, if I said it correctly, and lunch. But maybe I can give a moment to the audience if there are questions, if you want to ask something to the panel. Sorry, knowing that hopefully we can have them for the next days as well, but also the idea of this learning process that takes time for you to understand what the mandates are, takes time for the DFIs to understand what our work is in the projects and the programs that we are trying to run, takes time for them, for us to understand what they are trying to do. So what we are aiming in this session is really trying to demystify a little bit on the achievement of the context that we have with the DFIs and how to work together. They work together among themselves, they compete among themselves, they're being offered products by each other, and there is no reason why would not behave in the same way as an actor in this ecosystem. We know the solutions are, we need to find them, but we need to work together in order to achieve them. So maybe if there are questions? Oh, two. I'm gonna ask him in the three. So I'm gonna keep you three. I don't know if there is a mic in the audience. Maybe, are you a loudspeaker? How do you repeat your question? I can just project my voice? Yeah. All right. Well, good morning, everybody, and thanks for an excellent panel. A very brief question, which is, one of the players we have are national DFIs. And I appreciate that there's that competition we've heard about here. One consideration, one strategy, where there is a national DFI with some track record, you may want to partner with national level DFIs. I head up a DFI in Malawi. It's called the Malawi Agricultural and Industrial Investment Corporation. And the advantage you have of national DFI is, one, they've got boots on the ground, right? And two, they can help you navigate some of the political issues that I think the gentleman from AfDB was referring to. And indeed, they can help you with project preparation and building up pipeline. So perhaps it's more of a comment, but we haven't seen, at least in Malawi, a big effort to partner with national DFIs. And I think we have reached out to some of the institutions represented there. So partner with us, work with us. Thank you. We will hear more about Malawi in the next 2 days. Maybe I can ask Arif to have your question, and then you.
Thanks very much. I was trying not to intervene as co-host of this event, but this has been a really exciting and rich conversation. So first of all, thank you all. I just wanted to say a couple of things. One is this bridge between demand and supply of private capital. It's something we've been sort of reflecting on quite a bit. And part of this is why we had this genesis of the SDG partnership platform, which we haven't really spoken about, but there are sessions that will be coming up. And what we've identified is, besides the ticket size that I think was mentioned and the risk issues, there's also this issue of TA. We're getting 47 counties coming up with aquaculture, livestock, all kinds of value chain projects. But the packaging, the putting together of the pre-feasibility, et cetera, to make them investable and presentable to folks like you is often missing. And of course, most of them can't afford the big boys and girls in terms of the packaging, the audit firms and the like. So we're looking at establishing a TA facility. DESA has come in with some seed funding, and we're talking to other partners, but also looking to identify other TA providers in the market. We don't need to do it ourselves, so that we can improve the flow through of that. And secondly, also to say that on the supply side, we've strung along all the financing networks in Kenya and created what we call the National Advisory Board for Impact Finance. And this was a G7 initiative that David Cameron had launched many years ago. It supports about 30 countries already, 4 NABs in Africa running. So tomorrow we're delighted that we'll be launching Impact Invest in Kenya, which is an aggregate of the banks, the venture capital, the private equity, the foundations, pensions, cooperatives, etc. So at least the supply side gets a little more organized and perhaps more user-friendly for you. And then on the demand side, we're working with a number of county blocks and partners to try and see how we might streamline this. But I guess the request I have is that we would like to be coming back to you folks for a deeper dive on this issue, and look forward to that. Thank you.
Thank you so much. Good afternoon. And I want to add my voice to congratulate for the excellent panel, and really great to see the different institutions represented here. So my question is, we talked about the flexibility and the ecosystem to be more conducive for private investment from government or probably countryside. And now my question is, to what extent are you flexible also to accommodate the different needs from countries? If I look at the small and medium enterprises, it's very hard really to access and get into that space, because you were talking about the lack of bankable projects. But again, if we are not really giving that capacity and space for those to come into that space, it will be very difficult. And then we'll be talking about, again, the same thing after a few years. So I'm just trying to understand the flexibility from your side to accommodate and strengthen the capacity of those who doesn't have the capacity to access or meet your requirements. Thank you.
Good questions. And in the interest of time, I want to tie these two questions, or the first and the last one, together. I also want to say that we must appreciate the role that national development DFIs play. It's really critical. But also there's a layer to that. They're also regional, development banks who are doing amazing things. Now, luckily, AfDB has relatively almost equity in almost all of those regional development banks in Africa, and even some of the national ones. And what we do is we consider them to be very much an extension of the work we're doing, in that we've got set a minimum ticket size. For you to come to the bank, your project should be anything around $60 million, because we can only do minimum of 20. That's a third of that. We're trying to reduce it now to a minimum of $10 million. But then there may be some projects that are just $1 million or $2 million that may have a huge impact on the ground. So what do? Then we put money into Trade and Development Bank, East African Development Bank, or Malawi Bank. And then one example is Ugandan Development Bank. We actually gave a corporate loan of about $30 million to Uganda Development Bank. Very cheap, 15-year period, price at almost 3-4%, and then tie that together with some grant resources with a TA as well. And the whole idea was for them to do on-lending at anything between $500,000 to $1 million. And these were funding these small SMEs that are doing anything in the energy space or in the agro processing zones. So you may not call it an AfDB project, but by putting that capital in Ugandan Development Bank, they're able to do that operation on the ground. So I don't need to adjust my flexibility as it were, but I'm able to work with intermediaries who are able to accommodate your ticket size. And then through that partnership, because the TA that we give helps them to be able to develop the strength of their operations in a way that the quality is not different from AfDB. And so it's very important to be able to understand that we may achieve more by actually putting money in some development banks, national development, who can do those small scale projects that we cannot do directly. I'll keep it there. Thank you.
So I think, so because you answered the first two questions, I want to address your question in terms of how we support SMEs. I think in BII, we have a big program where we support small and medium enterprise. One, we provide financing to local banks so the local bank can address the local financing needs. The second one, which is I think one of the comparative advantage of BII compared to other DFIs, we work through a lot venture capital and PE funds. Actually, it's 1/3 of our portfolio where we provide financing to the fund. And then one thing this does well, by BII being investing in this fund, we play a big role in terms of catalyzing markets, so we can also raise additional capital from commercial investors.
I think if BII speak, I have to speak as well. No competition. No, but seriously, I think to address some of these challenges, when we came from OPIC, just to show you demonstratively how we decided to be more flexible, we launched a program called Portfolio on Innovation and Impact. This program just invests $1 million to 10 million. Previously, we would not do such small tickets, but now we could invest $1 million to 10 into early stage ventures, sometimes pre-profit, that are highly innovative, highly impactful. We gave $1 million to Kasha here in Kenya, and they given, we approved a loan to Power Internet. They provide internet in the hinterlands, in the low-income neighborhoods, etc. In addition to that, we launched our equity program because we did not do equity in the past. So we're able now to take on a more riskier position in some of these companies. And we also launched our technical development program. So if we find a company, we really want to support it, but maybe they have an outdated feasibility study or site impact assessment, we would fund that so that our investment team can continue to invest in it. At the moment, we are really, really grappling with the question of how can we provide local currency to some of these businesses, because the dollar or hard currency exposure is becoming unsustainable. And so that's a question we're actively exploring in partnership with Pan-African banks, just to see if we want to invest in this business. They don't want our dollars, they want local currency. How can we work together to provide this to you? So trying to think about different solutions. In addition, of course, to what my colleagues have said, partnering with other people who are able now to do that smaller, the small type of checks. We also have a program with the US Africa Development Foundation where, because our minimum is $1 million, they will do anything below $1 million with the hope that these businesses will grow into becoming now clients who we can fund. Thank you.
Thank you, Teddy. I'm very proud of this panel, and I'm going to give the last word to Adolfo.
Just maybe to focus on the question of Madame here. SMEs, I think that most of us will agree, SMEs are the backbone of a country, the backbone of economy in many ways. Not only by job creation, but also by the growth of the economy. And how to make actually capital available to SMEs is something that give us, I don't know how to put it, give us a lot of headaches, because sometimes when you come to economies where you can access a credit at 20%, and then you go back to an entrepreneur, then they will say, but how can I do business if I have to pay 20% to the bank, and then I have to pay also, in addition, another, depending on the country, 25% to the government. So I'm working both for the bank and for the government. So the question that you are doing to us is a difficult question to answer. There's a lot of work to do. For sure, when it comes to access to capital to SMEs, there are many different angles to tackle it. One is from the banking sector, but the banking sector have some constraints because you have the central rates that they have to follow, plus risk. Then you have private equity, then you have venture capital, you have different ways to provide capital to SMEs. And I think that the initiative from the platform of putting together different actors, as you just mentioned, on setting up an impact Kenya kind of platform, that will be very helpful because we have to try to look at it from many different angles. Yes.
Thank you, Adolfo. I was saying I'm very proud of this panel. I think we've learned so much about you and with you, and we will be hopefully talking and partnershiping, doing more partnerships together. Just before I finish here, I have a couple of quick announcements. Number one, we have one person to talk to you about Timbuktu. There is a very exciting project that is starting at UNDP. In the afternoon, we're going to have a private sector session starting at 2:30, hopefully. So let's see if we can do that to discuss ESG and the role of the private sector in the programs that we have, but also 3 breakout sessions to talk about energy access with examples in Madagascar and Zimbabwe, and of course experts in the topic. We're going to have a social impact session. We're going to focus on health and learn about programs in Kenya, Rwanda, and Ghana with WASH, water and sanitation. And finally, we also have a last session that is part of this deep dives that is on food security in agriculture with examples in Malawi and Angola. So please bear with us. But now I'm going to thank the panelists a lot. Thank you very much for your time, for your insights, for hope of working together. And I'm going to invite my colleague Elaine to talk about Timbuktu just before lunch. And then let's please try to be back around 2:30 to 40 after that. Thank you.
Thank you very much. Yeah, thank you.
There'll be a group photo. Huh? There'll be a group photo.
Oh, okay. Yeah. And there'll be a group photo. Let me just...
Good afternoon. I think you're all ready for lunch, so I'm not hearing anything. But anyway, good afternoon. My name is Elaine Gabramedhin. I'm the Chief Innovation Officer at the UNDP Regional Bureau for Africa in New York. And I'm on my 6th country of a tour, starting from Norway through the Nordics and then Kigali, and just arriving here a few days ago. Basically to talk about Timbuktu. So I wanted to really say that the session that we just ended is almost the perfect introduction segue into what we're trying to do with this initiative. Obviously, Africa is a very young continent. This has been said so many ways. That's not the main point, but it is a very important point, starting with these young people who we think of really as Africa's heroes. The youth that's going to take Africa to the next transformation. Let's see if I can make this work. Okay. Am I doing something wrong? Huh? Oh, where do I point? Over there? Oh, it's working. Okay. So, we talk a lot about COVID and all the terrible things that have happened, but actually one of the things that has been very good about COVID is that the world has seen an explosion of innovation over the period of COVID. So that's one of the reasons why we look at this as an opportunity and really try to leverage what's been going on over the last few years as these big problems that humanity faced led to an incredible explosion of talent being applied to solving those problems. The second big opportunity that we have in Africa is the AfCFTA, the promise of the One Africa market. And that's something that we're also trying to leverage as we go forward with this initiative. Let's see if technology works. So it's innovation time. If you look at these trends, and this is venture capital coming into the continent, over the last few years, Africa has exploded. Globally, 2021, there was an almost doubling of venture capital financing from by about 96%. In Africa, 2021, there was an explosion of venture capital coming into Africa, 253% growth, reaching almost $5 billion in venture capital financing. So the startup revolution has started, and this is projected to keep going. It's projected, I think, for 2022, 10 billion. So this is runaway growth. So if you look at just at a couple of companies, and obviously, I'm sure most of you have been following the growth of the unicorns on the African continent. We're now at almost 10 unicorns, billion-dollar plus companies. But just two of them, if I may highlight, starting 4 or 5 years ago, both of them, these examples are in fintech, but Flutterwave is now valued at $3 billion, has achieved in just 5 years, $140 million worth of transactions, valued at over $9 billion. And this is already dated, by the way, from a couple of months ago. Chipper Cash, a company recently invested in by Jeff Bezos, is valued now at $2 billion, started 3 years ago. A payment system, peer-to-peer, that serves over 4 million users across Africa. So we talk a lot about SMEs and all of that, but when you think about the impact that just these two companies are having on millions of SMEs themselves and the livelihoods and the transformational quotient that innovation can bring, then really we are, just at the tip of the iceberg of what's possible. But, where did my butt go? Okay, but, sorry, don't take it any other way. It's projected that despite this very rapid growth and this really, very bright story that we're telling, Africa is still at 0.2% of the global startup economy, the value of the global startup economy. So Africa's trade is at 2% of the global economy, but its startup value is only at 0.2%. So if you're a banker, then there's a lot of potential. That's opportunity. The other issue is that 83% of the financing that I was talking about is foreign capital. While of course there's nothing wrong with foreign capital, there is a problem when there isn't any domestic capital. And I think that was raised in the session prior to this, as well as the first session. So we've got to do something about how to harness pools of capital lying in domestic hands. The other issue is that 87% of this venture capital financing for innovation is concentrated in 4 countries, and you probably know which ones they are: South Africa, Kenya, Nigeria, which is number 1, and Egypt. So we've got to figure out how to spread this capital. And of course, of that 87%, more than 55% is going to one sector, fintech. So recently, the Tony Blair Institute put out an estimate of a $90 billion annual financing gap to meet the potential that African startup economy would have. So looking at this, we had at UNDP Regional Bureau for Africa have started working on, and have been working on rather, an initiative we're calling it Timbuktu, hearkening to the glory of Africa, the old, knowledge capital, Timbuktu, the hub of Pan-African trade, and really thinking about how to solve Africa's innovation ecosystem and harness these very exciting trends. So our three priorities in Timbuktu are to address early stage risk capital, and that was talked about extensively in the previous panel. Secondly, the fact that if I were to go back to those two examples I gave you and many others, if we go to each of the unicorns, not only is the capital foreign, but the founders are coming also from foreign sources and coming with foreign, or let's say non-indigenous knowledge. And so that it's really something where if you think about where we have knowledge on the continent and in any region, it's in universities, research being done in corporate R&D, in university research, in non-university research institutions. And so how we can harness knowledge that's produced on the continent to fuel this innovation explosion, or let's say the startup revolution, is a big issue. And I came, by the way, to UNDP very recently. I'm from the private sector. My own DNA is that I founded the Ethiopia Commodity Exchange, which was turned into a $1.4 billion trading platform. And after that, I started working with innovators in Ethiopia, young people. And one of the things I saw is that they would come with amazing ideas, and I would say, this is fantastic. Where did you get this idea? You're going to apply drones, optimize crop spraying, etc. And they would say, oh, this was my senior project at university. And I say, fantastic, let me talk to your advisor. We need them in your company, because that's somebody who's been thinking about this stuff for 10 years, has a PhD. We need that talent, we need that knowledge. And they would say, there's absolutely no way that my advisor can talk to you or be part of my company, because it's not allowed. So somehow we need to think about tech transfer policies. We need to think about how to harness what we already have as part of this thrust, if we're going to get it right. So bringing that ecosystem to bear is also the other part of what we're doing. The third is that, and this is also something I saw over and over, and I think we can all talk about this if you are investors, is the size of market issue. We have this enormous potential, the 1.2 billion population on the continent, the $3 trillion market economy, and yet for the most part, our startups are thinking within borders because they don't know how to get beyond those borders. So how can we unlock the promise of AfCFTA, which for a startup seems something, going on in AU, in boardrooms, that has nothing to do with the reality of a startup, of an entrepreneur trying to build a market. And I saw this again over and over with my companies. In fact, some of them, we got them to pitch to, Draper in Silicon Valley. And, he looked at one of my startups and said, this is a fantastic idea, but I won't do it unless you can do it across Africa. Ethiopia is too small. So that's a problem that we have to solve as well. So with these three priorities, I'm now going to tell you, well, actually, let me talk for a minute about the risk capital. This is, of course, the famous startup financing capital. You're probably familiar with what we call the Valley of Death, which is the period from where you have your idea that's being incubated and is, in prototyping and sort of market testing phase until you start to break even. So in that period, which is called the Valley of Death, there's a very, very huge gap in terms of early stage risk capital. Somebody, I think was DFC, that was saying, we go now to lower ticket sizes, $1 million and above. That's great, but what do you do between 50,000 to $1 million? And that's the gap that we're playing in. So where we aim to play, if you will, is between the pre-seed all the way to Series B. Now, in other regions, Series B is much higher than 2 million, but if we think of that as sort of, roughly a Series B, then that's kind of where we see the gap and where we think we can have impact. So on the ecosystem side, these are just some of the nodes in this unwieldy, complex thing called the startup ecosystem, and it involves media, it involves government policy, it involves universities, it involves talent, and so on. And then, of course, the actual ecosystem builders, the hubs, accelerators, and so on, which themselves have a very fraught business model, chasing grant money, chasing, a donor challenge program grant or a hackathon or something like that. And that's kind of the same treadmill that the startups are on, going from one $5,000 pitch competition to another pitch. At one point I told my startups, no more. You're not building businesses, you're just chasing pitches. And we have to actually build businesses. I've already talked about the Pan-African markets, I'll skip this. So now, how are we going to go about this? And so let me tell you just in the next few minutes, recognizing that lunch is coming right after this. So what we're aiming to do is to build something that, well, actually even before I get to that part, let's talk about the objective. So it's a 10-year horizon, 10 plus, but really for typical UNDP business, this is a very different way of going about things. We're aiming to mobilize and invest $1 billion over that period of private and public capital, aiming to achieve, now coming to the results side, the 1,000 startups at scale, which essentially means that our funnel is much, much larger, with the objective of tracking and achieving impact on 100 million livelihoods, planetary objectives as well. So this is something we're modeling, and there's a different pitch deck for that to explain the impact modeling that we're doing, and to create 10 billion or 10x value creation. One of the things that always comes up when we talk about the the overemphasis on foreign capital is that value doesn't remain on the continent. So it's going back out. So how do we retain that value? How does that value, have impact on the economies of the African continent? So now coming to the what, and this is the distributed Pan-African Innovation Network that we're aiming to establish. And so the idea, and this is a little bit indicative because as we speak, I have a colleague who's here who's been on an even longer route around various countries, doing what we're calling an ecosystem assessment, talking to different players in different countries. So what we're trying to do is to put up 8 hubs that are each Pan-African in places where the startup ecosystem is already flourishing, getting off the ground, maturing. And in those ecosystems, and if you see which ones they are, Cairo, Casablanca, Dakar, Accra, Lagos, Kigali, Nairobi, and Cape Town, and we're looking at a few others as well, so it might be actually 10. But the idea is to leverage what's already there, to work with players in the private sector that are already there, to work where we see a critical mass of investors and early startup successes. So that's sort of the first piece of the what. So now digging a little bit into what we mean when we say hub, because that's becoming a very overused term. What we're aiming to do in each hub is to have 2 pillars. One is the venture builder, which integrates the ecosystem. And that venture builder would be working with all the players, as I said already, the universities, etc. And then on the other arm would be a venture fund in each of these hubs. In terms of the hub itself, it would be privately run. This is not a development project. This is not a long list of donor logos. This is really something that is private sector facing from the get-go. So there would be a consortium that would be competitively selected for each of these hubs. And that consortium would have capacity and track record on both sides, on both the ecosystem building as well as the venture financing. The other thing about what we're trying to do is to map a single vertical to each of the hubs. So they're not trying to do everything. They are essentially creating a center for excellence, deep domain expertise, partnerships around a vertical. And that would be the logic on both the builder side as well as the fund side. And each of them would be positioned as a Pan-African hub, meaning that they would be accepting and welcoming and working with and launching or growing startups from around the continent. So if we think about the verticals, obviously fintech comes to mind, but also agri-tech, ed-tech, creatives, tourism tech, health tech, trade tech, green tech, sustainable energy, commerce, and smart cities. So we're now in the process with our team of mapping different verticals to each of the hubs. And we're trying to keep it one per, but it might be in some cases more than one. The logic of that is that, as I've already said, to build that kind of domain expertise, but also to avoid cannibalization, that everybody's trying to do the same thing and they're all trying to partner with the same, life science company or the same, program, for example, with Novartis for health tech or something like that. So, so that's kind of the logic. And if we apply, because this is, after all, an SDG meeting, if we apply an SDG lens to this, then without explicitly saying we are an SDG fund, in fact, we don't even say we're an impact fund, but we know that that's really something that can be easily mapped, and that's essentially where we would be going. So now on the structure of how we would go about this, we have not a fund of funds, but a parent and subsidiary structure that we've kind of thought might be more appropriate. One of our inspirations is that we've done a deep dive into the YOSMA program in Israel, if you're familiar with that, in the 1990s, sort of the basis of how Israel grew its startup economy and became the startup nation. We've looked at Singapore, we've looked at Finland, and so this is something that we think can be an innovation in itself. So the parent fund is a catalytic fund where UNDP, development partners, foundations, governments, even individuals might decide to partner. And that parent fund establishes the subsidiary hubs. And each of those funds is as I said, has the two arms with the sort of firewall between the venture builder and the venture fund, with an investment committee and a full, commercial undertaking for the venture fund. So the parent fund finances, at least for the initial period, entirely the cost of the venture builder. Sometimes when people talk about blended finance, they talk about TA. We don't have an arm for TA. What we have is a financing of this private sector run ecosystem builder or venture builder that is essentially a way to support pipeline. And I think it was Alonso that kept saying pipeline, pipeline, pipeline. Well, we're always saying the same thing. And so, and I've been on the side where there's pipeline but no funding, and I know many people on the fund side that have funding but no pipeline. So we're trying to bring both sides together. So on the parent fund would therefore finance 100% the venture builder, and then put a minority stake, we're thinking between 35 to 40%, into the venture fund, with the remaining coming from private co-investors, purely commercial LPs that are, could be, in fact, DFIs. We had another box with, indicative partners, but we see definitely DFIs in that area, but also other funds and other types of investors. So I think I've already said this, but on the venture builder side, the idea is to partner with corporates, with universities, with mentors, partners, makerspace, providers, other corporate services, biz services, etc. So really to kind of unlock and really put out high quality pipeline that the venture fund can pick off of, but the venture fund can also invest elsewhere. So the logic is not that this is some kind of a project where if a company has gone through the venture builder, they have an automatic pass through to the venture fund, because that would easily derail the commerciality of this model. So it really is that the venture fund operates as a commercial venture fund, and we're now going into very, very detailed structuring, and we've just onboarded a company in Germany that will, work through this model in great detail for those of you who might be interested in further conversations. There's also an HQ. We actually just announced, and I came from Kigali, where we just did a big announcement that we're going to be putting the headquarters in Kigali, and have a very, very strong commitment from the government of Rwanda to really, fuel this effort in whatever ways they're planning or can bring in. So what happens at the HQ level is obviously also important for this whole network. And so it's things that are additional and relevant for what we're trying to do. Corporate services, communications, but also media, telling the narrative, telling the story. We just don't have enough of that. We don't have, and we've now been talking to CNBC Africa, have also reached out to Bloomberg Africa, both of which are very, very interested in setting up a business programming that would be something that would tease out what is happening in each of these hubs, but in general with startups in Africa. There are a few, Quartz Africa, Disrupt Africa, a few entities that are scratching the surface, but we will have so much content coming from this distributed network that it's very interesting for the media companies. The other thing is something like a Shark Tank that will again have massive impact in terms of exciting young people, educating people about this space. Another thing is, and we just, as I mentioned, we're in the Nordics, so we talked to folks in Finland about, if you've heard of Slush, which is the world's largest startup event, bringing 30,000 people to, investors, startups, and other ecosystem players in one space. And that's really where, the future of how we do business in this area is going. So we don't have something like that on the African continent. So that's something else that we will work with partners to bring as part of this initiative. And then things like data tracking, M&E, impact tracking, etc. So I think that's about it. These are the Paystack co-founders who sold Paystack, a fintech in Nigeria, for 200 million in their 20s. And just to say that this is a bold young Africa, and we're running fast, and we're also being very bold. Thank you. If you want to go any further with us, we want all of you, especially those of you in the investment world. I have put up my, oops, where did it go? I have, going the wrong direction, sorry about that. Just my information. There it is. So I'll stop on this slide. I don't know if we have time for questions. Happy to take some if you do, or we can just chat at lunch, but these are my details, and love to talk to you and love to work with you. Thank you very much. There you go. I think I kept it within my
you kept it within your 15 minutes. Thank you. Another round of applause for Eleni. So I see a number of us have already grabbed our things. No need to worry. Lunchtime it is. So each of us have been given this. This is what you'll use for your lunch. It's at Nyamachoma Ranch. But before lunch, we'd just like to request you, at the entrance, we'll be taking a group photo together to keep it for the books. And then we come back at 2:30. Thank you so much. And for our online audience, feel free to grab some lunch too. Thanks.